If you haven't filed taxes in 3, 5, or 10 years, the thing you're probably most afraid of is not the thing that usually hurts people. Most people think the biggest danger is prison, but in most cases, the real danger is something much more boring and much more expensive. It's the IRS creating a tax bill for you without your deductions, without your expenses, and without the full story. And once that happens, a problem that might seem manageable turns into something that feels impossible. Here's why this happens. When people fall behind on filing taxes, they usually assume two things. First, they assume that if they stay quiet, maybe the IRS will forget about them. Second, they assume that if they come forward, they'll make everything worse. Both of those assumptions can cost you a lot of money. Doing nothing does not freeze the problem. It usually gives the IRS more time to build their case, assess the tax, add penalties, add interest, and eventually move you into collections. I'm Brad Paladini. I'm a tax attorney and founder of Paladini Law, and my team and I help individuals and business owners who owe the IRS more than they can handle get out of tax trouble with clear, realistic plans they can actually afford. In this video, I'm going to show you what actually happens when you don't file taxes for years, what the IRS does behind the scenes, and the mistake that creates inflated tax bills, plus the step-by-step process to get you back into compliance safely. And make sure you stay until the end because I'm going to explain why filing every missing year is not always the right move. Let me start with a pattern that I see all the time. It almost never starts with someone deciding, I'm not going to file taxes for the next 10 years. It usually starts with 1 year. Maybe you owed money and couldn't afford to pay it. Maybe you were self-employed and didn't make estimated tax payments. Maybe you went through a divorce, a health issue, a job change, or a business problem. So you skip one return, then the next year comes around, and now you don't just have this year's return to do, you have to deal with last year's return too. Now it feels heavier, now it feels more embarrassing, now it feels like something you need to deal with later. So you avoid it again. Then 1 year becomes 2, 2 becomes 3, 3 becomes 5, and at some point, people stop opening IRS mail altogether. They stop checking transcripts, they stop looking at the problem, but the IRS does not stop looking at them. This is the first thing non-filers need to understand. Even if you don't file a tax return, the IRS may already know a lot about your income. Your employer sends W-2s, companies send 1099s, bank and brokerages send income tax reports. Payment platforms, clients, and other third parties may also send information. So when you don't file, the IRS is not always sitting there with a blank page. They may already have a pile of income documents connected to your Social Security number. In the beginning, the IRS may be passive. You might get notices reminding you to file. You might not see immediate enforcement. And that quiet period is dangerous because it gives people the impression that nothing is happening. But quiet does not mean safe. After enough time passes, the IRS may identify you as a non-filer and start preparing what's called a substitute for return. A substitute for return is basically the IRS saying, if you won't file a return, we'll create one for you. But you need to understand something. They're not creating a return in the way a tax professional would. They're not looking for every deduction. They're not hunting for every credit. They're not asking what business expenses you had. They're using the income information they have to assess tax against you. And that often means the tax bill is much higher than it should be. No business expenses, no proper deductions, no credits you may have qualified for, no favorable treatment that may have applied if the return had been prepared correctly. This is where people get crushed financially. Let's take a simple example. Suppose you're self-employed and you brought in $100,000 of revenue, but you also had $60,000 of legitimate business deductions. On a properly prepared return, you may only be taxed on $40,000 of net income. But if the IRS prepares a substitute for return using only the income documents they have, they may treat that $100,000 like pure profit. That means you could be assessed on income you didn't actually keep. Then the penalties start stacking on top. Failure to file penalties, failure to pay penalties, interest that keeps growing. And now the original problem is not just that you failed to file, the problem is that the IRS may have created an inflated balance that does not reflect your real financial situation. That is why waiting can become so expensive. Once the IRS assesses the tax, either through your own return or a substitute for return, the case can move to collections. This is where the tone changes. At first, the IRS may ask you to file. Later, they may assess the tax. Then they may start collecting. That can mean tax liens. That can mean wage garnishments. That can mean bank levies. That can mean serious pressure on your paycheck, your bank account, your business, and your ability to move forward financially. But here's the important part. Even after years of not filing, the IRS still generally prefers that you come back into the system voluntarily. That means you may still have options, but you have to handle it correctly. The goal is not to panic. The goal is to get compliant in a way that does not create unnecessary tax, unnecessary risk, or an impossible payment plan. So, how do you fix this safely? Step 1 is to get your transcripts. Before you start filing returns, you need to know what the IRS already knows. That means reviewing your wage and income transcripts, account transcripts, and any information the IRS has connected to you. Your wage and income transcripts show your W-2s, your 1099s, and any other income forms reported under your Social Security number. That matters because if you filed based on memory, old bank statements, or guesswork, you can miss something. And missing something creates new notices, new problems, and more delays. You don't want to guess yourself back into compliance. You want to know what the IRS has on you before you respond. Step 2 is to file the right years in the right order. This is where a lot of people make a very expensive mistake. They assume that if they missed 10 or 15 years, they automatically need to file 10 or 15 years of returns. That is not always true. The IRS commonly looks for the last 6 years to bring someone back into filing compliance, although your specific facts can change that strategy. And this is why you do not want to file blindly every missing year without a plan. I represented a business owner who went to a CPA before coming to us. He had many years of unfiled returns, and he was advised to file 15 years of returns. That created a massive 6-figure bill. But the painful part was this: the IRS had only been looking for the last 6 years. By filing years that may not have been necessary, he created a tax balance that was 3 to 5 times higher what it needed to be. And once those returns were filed, the IRS was more than happy to collect the money. That is why the order matters, the years matter, the strategy matters. Step 3 is to replace any substitute for returns that are hurting you. If the IRS already filed SFRs, that does not always mean you are stuck with them forever. In many cases, you can file accurate original return and replace the IRS version. This can be one of the most powerful ways to reduce the balance, because now you may be able to include the deductions, credits, filing status, and business expenses that the IRS did not include when they created the substitute for return. That can reduce the inflated tax. It can correct the record, and it can completely change the conversation about what you actually owe. But this only works if the returns are prepared correctly. A rushed or sloppy return can create audit risk, delay the resolution, or lock in numbers that are still wrong. Step 4 is to build a realistic payment strategy. Once the returns are filed and the real balance is known, then you deal with the payment side. This is another place where people panic. They get scared, call the IRS, and agree to a payment plan they cannot afford. This may feel like progress for a few months, but if you default, you can end up back in enforcement. A good resolution should be based on your real financial situation, not fear, not pressure, not a random number that sounds good on the phone. Depending on your situation, the solution might be an installment agreement. It could be currently non-collectible status. It could be an offer in compromise, or it might be another strategy entirely. The key is that the plan has to be sustainable. If you cannot afford it, it is not a solution. It is just the next default waiting to happen. Now, let me give you one of the biggest mistakes I see non-filers make. Mistake number one, hiring the wrong people. If someone promises pennies on the dollar before they understand your income, assets, expenses, filing history, and IRS account status, be careful. This is marketing, not a plan. Mistake number two, rushing to file sloppy returns. Getting compliant is important, but inaccurate returns can create new problems. You want the returns done correctly, not just quickly. Mistake number three, ignoring substitute for returns. If the IRS created inflated balances for you, you may be able to replace those returns and reduce what you owe. Ignoring them can mean paying far more than necessary. Mistake number four, agreeing to impossible payments. A payment plan only works if it fits your actual financial life. If the plan is doomed from the start, it can trigger the same enforcement problems you want to avoid. And mistake number five, waiting until a levy or a garnishment forces action. The earlier you deal with the problem, the more options you usually have. Waiting does not make the IRS disappear. It usually makes the solution harder. So let's recap. If you have not filed in years, the first problem is usually not that the IRS has no idea what happened. The problem is that the IRS may already have income information and may eventually use it to create a tax bill without your full story. That bill can ignore deductions, credits, expenses, and other facts that matter. The penalties and interest can make the balance grow, then collections can begin. But the situation is fixable if you approach it in the right order. Get the transcripts, identify the correct filing years, replace bad substitute for returns when possible, then set up a payment strategy that is based on reality, not panic. If you take one thing from this video, remember this: the longer you wait, the fewer options you may have. But if you handle it correctly, years of unfiled returns can often be brought back under control. If you are in this situation and want to know what your safest next step is, we offer consultations where we review your specific facts, identify what years may need to be filed, look at whether substitute for returns are involved, and map out a realistic path forward. No guessing, no generic advice, no panic-based payment plan. Just a clear strategy to get you back into compliance and protect you from enforcement. Click on the link below to schedule a call. And if this helped you understand what really happens when you don't file taxes for years, subscribe to the channel because I break down IRS problems like this every week so you know exactly how to handle them.